And in reality, the difference between a 15 or 16% IRR in total dollars, it's not that much. It's really not that different. But there's a big difference between somebody taking your money and burning it into the ground or losing it.
Huge.
Or not.
We have Mr. Omar Khan. Omar is a principal at Boardwalk Wealth and CFA charter holder with 10 years of real estate and commodities investing experience. He has advised on $3.7 billion of capital financing and M&A transactions, syndication or syndicated multi-million-dollar investment deals, and advised high net worth entrepreneurs on real estate portfolio allocations. Omar, how you doing?
Thank you, Chris. I'm doing great. I'm really pumped up after that introduction.
Yeah. Well, in writing it too, define real quick, because full transparency, I didn't know what this was. CFA charter holder. I looked it up.
It's basically, okay. Realistically, in practical terms, what it means is that I was chained to my desk on the investment banking and corporate side for most of my 20s, working 80 to 100 hours a week, and then studying like crazy. But it's the gold standard in portfolio management, setting up portfolios, managing the risk, the entire stream basically. So let's assume you're a portfolio manager at one of these big shops. You cannot get a job, you won't even be considered without a CFA these days. I mean, so that's kind of what it is.
Yeah, when I looked that up, I was like, holy crap, wow.
Yeah, trust me, if I knew what I wanted to do, I probably wouldn't have done the CFA.
Well, it's a pleasure to have you on. We got a short time. You're in a unique position where you not only manage but also advise high net worth individuals. You've seen a lot of things that most people on this panel even haven't had the opportunity to see. What should, and regardless of the type of asset, regardless of the size of asset, but we are focusing on multifamily syndications. Passive investors, what should they consider when getting into their first deal?
Like if you're talking on the private equity side, right? Not like
correct. Not the operator.
Okay, yeah. Well, look, if you're on the private side, right, where you deal with say a sponsor like me, or I don't know if Chris you do deals, but assuming you do deals and people like you and me, what you should be. Everybody I understand is so fixated on returns and risk and this and that. And in my experience, at least, what I tell is, look, if there's an experienced operator, any question you ask, they probably heard this before like a million times. What you're really trying to do, in my opinion, at least, because I invest in other people's deals, that's what I'm trying to do, is what you're really trying to understand is screening the person for values and competence, basically. So in a way, let's put it this way. If the person is very honest, but a complete idiot, you don't want to be with that person because their honesty is useless because, I mean, they don't know how to do the work, right? I mean, your money's at stake. Or conversely, if the person's extremely competent, they're world-class at what they do, but they're a very dishonest person, right? Well, you also don't want to be in that situation because you don't want to be with the smartest crook in the world. So as an investor, it's a lot of this, people get hung up on the numbers. Oh, it's a 15% IRR, 17% IRR. But a lot of this comes down to basically a qualitative analysis. Like, is this person that I'm hopefully looking to give my money to, do I feel this person will be a good steward of my capital? Look, and in reality, the difference between a 15 or 16% IRR in total dollars, it's not that much. It's really not that different. But there's a big difference between somebody taking your money and burning it into the ground or losing it.
Huge.
Or not.
Huge.
So that's what you're really focusing on. So if you've got, say, whatever, out of the 100% of time you're going to take to assess an investment or a person, I would literally spend 99.999% on the team or the people, and don't worry as much about the actual return and the deal, because if the people and the team are competent, experienced, and the right people for you, the rest will take care of itself.
Yeah, and that's been a theme with the guests coming on today. And this just popped in my head. Another analogy: a doctor. So a doctor that's very honest but incompetent. Are you going to allow them to do open heart surgery on you? No. But if they're very competent, but they've got a whole stack of unethical charges on them, are you going to let them operate?
No.
You got to have both.
It's the same thing. Whatever we do in our lives, right? Like you're talking about this doctor example. There's countless examples of professionals and vendors we use in our own lives. The same criteria has to be applied to these sorts of situations. It's just because it's real estate or, I don't know, a business, private business, the criteria doesn't change just because somebody wears a nice suit and has a tie on.
Yeah. Return of capital over the actual returns of the
Yeah.
capital. So what are there any markets, just because your unique position, are there any markets right now that are outside the obvious, that you're kind of seeing that it's really catching some momentum that maybe folks should look into?
Look, I'm only looking in the Southeast because we have a real estate portfolio, but we also have operating businesses. Like, for instance, we're starting and launching off publicly, at least, a QSR fund, which is fast food restaurants. But that's more of an operating business. We don't own the real estate. We just operate the business. We acquire businesses.
Mm-hmm.
I'm a big shareholder in a fitness equipment company. So for me, the market, and even in real estate, for me, the market is important. But what's more important is the opportunity, right? So a lot of times I will look at, say, a market where I might not have naturally looked at just because I'm getting something at a deep discount.
Mm-hmm.
So for me, I think it's very important to be flexible and not be so fixated on one area of the country. So I would like to give you a clear answer, and I don't have one because a lot of this is dependent on what deal I get.
Well, no, and that is a good answer because inventory, especially on the real estate side, inventory is low. You do have to be flexible. We were doing that when we were flipping single family. I mean, eventually our radius of our market had to get really, really large because ultimately I was just looking for a good deal.
Exactly.
I knew I could figure out the market. And then, of course, there are obviously, we look at the market when we had the opportunity and decide whether or not that made sense.
So I'm not trying to say the market isn't important. It is important, but price, or rather the price I get relative to my other options for a similar quality product, that's what's most important to me.
What concerns do passive investors, or you find in some of these high net worth individuals, besides actual return of capital and knowing the operator, is there anything that they really want to see up front, in whether it's the PPM or the deck or anything? Is there anything that they really like to see crystal clear in the communication of an opportunity that you think more operators should be providing?
Yeah, being clear in basically what they're doing, number one, as a strategy, and what the capabilities of their team are. So as an example, a lot of times people will ask a question about, okay, can you tell me about, say, a project that went awry, right? Something that didn't work out. And people start talking in vague generalities, right? So if you've been around the block and if you've taken the pain of projects going bad, which happens, by the way, to everybody, because it's not just things going bad, you can recover as well, right? If you're very specific and say, look, the rent growth we were expecting and modeled off didn't work. In this case, we had a lot of bad debt. I'm using this as an example, had a bad debt accumulate because of COVID or government restrictions, some version of that. And this is a plan we had. We had adequate cash reserves built in. And you got to walk people through a path. This is a problem. This is the situation. These are the actions we took, and this is the result that happened. Yeah, right? Yeah. And basically clean, crystal clear words, no fancy words. It's very easy to understand. People are more apt to believe that and trust it because you've been able to explain your situation versus talking, well, the market kind of went down and then it kind of went back up.
It's back to transparency and honesty, but also ownership.
Ownership, yes, but the fact is you also have to go through that situation, right? Because a lot of times people pretend to be what they're not, and a lot of experienced investors, they're able to see through that very quickly.
Yeah.
Again, none of this is quantitative, right? It's all qualitative assessment of somebody's character.
Yeah. I've heard some investors, like, this is outside of just real estate. They really won't know. I think even real estate, they won't even invest in an operator that hasn't gone through the pain because they want to see that on the track record of how that was dealt with.
Yeah, I've heard of that. That's interesting. I mean, I don't know if I would be that militant yet, but that is a very fair point.
Yeah, love it. Well, Omar, it's a real pleasure. I'm glad we got connected. Look forward to talking with you again soon.
Yes, sir. Thank you very much.
Thank you. Take care.